Imagine this. A company announces the best financial results in its entire history. You'd think the champagne would be popping, right? But instead, the stock price tanks. Now that's not just a little weird, it's a warning sign. It feels like an echo from a time when the market got something catastrophically wrong.
And that question, right there, is the key to everything we're about to unpack. It forces us to look past the flashy headlines, to look deep inside the engine of the AI revolution and ask a pretty terrifying question. Is this whole thing just running on fumes?
Okay, so let's just break this down. On one hand, you have NVIDIA, the absolute king of AI chips, posting a jaw-dropping $57 billion in revenue. In a single quarter, that's just astronomical. But on the other side, the market kind of panics and the price drops. The very people who should be celebrating are selling. This massive disconnect. It tells you the smart money is seeing something that maybe the rest of us are missing.
And you know, this isn't the first time we've seen this play out. This whole strange situation has a historical echo. I mean, think back to the late 90s, right? The dot-com bubble. Valuations were through the roof, completely disconnected from reality. What we're seeing now, it feels eerily similar, like a quiet tremor before a potential earthquake.
So to really understand what's happening here, we have to do what you always do, follow the money. And in this case, we're not talking about millions or even billions. We're talking about trillions.
Just let this number sink in for a second. $246 billion. That's how much was spent on AI infrastructure this year alone by just 4 companies: Microsoft, Google, Amazon, and Meta. This isn't just an investment, it's a high-stakes gamble on a scale we have never seen before.
And where is a huge chunk of that money going? Well, it's flowing right into one place: NVIDIA. Just look at this growth chart. Their stock has exploded over 1,000% since 2022. I mean, this isn't growth, it's a vertical rocket launch. And it's all fueled by this belief that AI is the future and NVIDIA is selling the picks and shovels in a new digital gold rush.
To try and put that valuation into perspective, think about this. With what NVIDIA is worth, you could buy the entire Walt Disney Company 25 times, or you could buy Nike 50 times over. It is a valuation that absolutely dwarfs entire industries built on iconic household brands. It's just staggering.
And this concentration of wealth is, well, it's pretty extreme. We're talking about just 7 AI-related tech companies. People call them the Magnificent Seven, making up over a third of the value of the entire S&P 500. So that means just 7 companies are basically driving the whole market, while the other 493 are just kind of along for the ride. That is an unbelievable concentration of value and an unbelievable concentration of risk.
All of this, the weird paradox, the mind-boggling valuations, the insane market concentration, it all points to one critical concept: a financial bubble. It's when excitement and pure hype drive a price so far beyond its real, fundamental value that it just doesn't make sense anymore. And the question we have to ask is, are we in one right now? But you know, the cracks in the story aren't just financial, they're technological. Because while all this money has been flooding in, a chorus of doubt has been getting louder and louder. And the scary part? It's coming from the very people who built this machine in the first place.
See, for the last 5 years, AI development has been all about one simple, almost religious belief: the scaling law. The idea was that if you just kept making the models bigger, feed them more data, throw more computing power at them, they would just magically get smarter. And hey, for a while, it actually worked. It took us from GPT-2 to GPT-4, until, well, suddenly, it stopped working.
This is Ilya Sutskever. He's a co-founder of OpenAI, one of the main architects behind GPT-4. When this guy talks, the entire industry listens. And what he's saying is, they've hit a wall. They've basically scraped the entire public internet, all of it, and there's just no more high-quality data to feed the beast. The old strategy of just get bigger, it's over.
And then you've got Yann LeCun, who's Meta's chief AI scientist, another godfather of AI. And he's even more blunt. He says the whole approach of these large language models, it's a dead end. Yeah, they're amazing at predicting the next word in a sentence, but they don't actually understand anything. As he puts it, a simple house cat has a better grasp of reality. I mean, think about that. These multi-trillion-dollar systems lack basic common sense.
So why is this happening? Well, cognitive scientist Gary Marcus explains it perfectly. we've hit a point of diminishing returns. It's like squeezing a lemon that's already dry. You can squeeze with all your might, but you're not getting any more juice. And this explains the whole hallucination thing, when the AI just makes stuff up. It's not a bug that you can fix, it's a fundamental feature of a system that can only ever predict the next word without ever truly understanding what any of those words actually mean.
Okay, so if the core technology is hitting a wall, how on earth is the financial hype still accelerating? This is where the story takes a really troubling turn. It starts to reveal a financial structure that looks less like a revolution and more like a circular house of cards.
Just follow the money here. It's wild. It starts when a tech giant like Microsoft invests billions in a startup like OpenAI. Okay, step 2. That startup turns right around and uses that exact same money to buy the essentials. Chips from NVIDIA and massive cloud computing services from, you guessed it, Microsoft. And here's the kicker. That spending gets booked as new revenue for Microsoft. The money never really left the building. It just went out one door and came right back in another, creating the illusion of a booming market.
And OpenAI is the poster child for this whole paradox. On paper, it's valued at a massive $500 billion. But the reality? The company is just hemorrhaging cash, losing $5 billion last year alone. It's burning through its investments at a truly incredible rate, and its revenue doesn't even come close to covering its gigantic costs.
This quote from Michael Burry, the guy who famously predicted the 2008 housing crisis, he just sums it up perfectly. He's saying there's almost no real demand from actual paying customers. Most of the so-called customers are just other tech startups, all funded within this same closed loop, which all leads to the terrifying trillion-dollar question: who is actually going to pay for all this in the end?
And that is the trillion-dollar question, isn't it? When you combine a technology that's hitting its fundamental limits with a financial system that is essentially just paying itself, you create an incredibly fragile structure. So what happens when the music stops? So, where does all this leave us? Is this entire industry just a bubble that's about to pop? Well, maybe not. This might just be the painful but totally necessary end of one chapter and the beginning of the next one. Let's go back to that historical echo we started with, the dot-com bubble. In 1999, the hype was absolutely off the charts. By 2001, the bubble burst, wiping out trillions in speculative cash. But what happened after the crash? That's the most important part of the story, because out of those ashes, new, sustainable giants rose up, companies like Google and Amazon, who focused on building real businesses with real customers. And here's the crucial insight from all that. The dot-com crash didn't kill the internet, not at all. It only killed the hype. The crash was this painful but necessary filter. It forced the entire industry to grow up, to shift from just speculation to actually building things people would use. It separated the fiction from the function.
And that is very likely what we are all witnessing right now. This is not the end of AI, but it is the end of the simplistic, bigger is better era. It's forcing a really important shift away from brute force scaling and towards genuine, clever innovation. It's a painful, for sure, but ultimately healthy correction of what we all expect this technology to be.
Which leaves us with a final, really fascinating thought. The first road, the easy one, where we just made things bigger, is now closed. We are entering a new, much harder, but ultimately more interesting era of real research. The big question is no longer how big we can make these machines, but how smart. And in the search for that answer, we might just end up learning a whole lot more about our own intelligence than we ever expected.